Welcome back, everyone. Sorry for the late start. Um, so, big week in the markets, always, and trend following is not letting us down in the least. And how much fun are we having? I mean, just can't get. It's not going to get any better than this, and we hope it continues. So, I have a lot of fun things to talk about today, and but I want to hear what everyone else wants to talk about as well. If you want to speak, just please let me know. Um, Request to be a speaker, and you'll be a speaker. And if you go too long, I'm going to have to mute you and take over control. But I'll obviously bring you back, and so we can keep it moving and keep it interesting for everybody. So I'll start out with Oleg. Do you have any thing you want to talk about this morning, Oleg?
Hi to everyone. Very happy to be here, as I always say. And of course, I often say that I was waiting all the week this our trend following trading club conversation, and this is not exception. Of course, all the week I was waiting for it every day, and I was thinking a lot about trend following. Also, was very impressed when I was listening to Richard in Neil's podcast. I liked a lot of things there, and by the way, I was also thinking about the ability of our brain, the ability of our nature to predict, and that I was really impressed when he said that. We try to predict the future because we need it to survive. And to understand the world near us and the markets, we are not designed, we are not organized in such way to deal with the markets in such way. And it's very, very interesting, and I have thought about this a lot, I want to say. And also I want to say that in a previous our trend following meeting, I said about that some people which I have met don't like the idea of predictability. People who are not far from the markets, from the finance, but they say that, and predictability is not perfect. And this week, I have heard also from people from the business side that predictability is not perfect. And I think that now, when the world saw Corona crisis 2020, what is happening now, and so on and so forth, it get a reminder to people that is no sense to predict. We need something else. But people, it's very important for us, don't know what they need. They really don't know. Maybe they think that if value investing or something like this is not good as they thought, maybe it's buy and hold or real estate or something like this. They don't know about trend following. It is what I see. And I think that it's maybe a reason, maybe wrong, why this industry is so maybe little. People need trend following, but they don't know they need it because they don't know about it. A lot of people.
G'day, Jerry. G'day, Oleg. Hello, everyone. Great to be here. Looking forward to some good debates tonight. One on the agenda, I think, from the Twitters this week is perhaps going to be about why, say, Jerry and I like medium to long-term trend following versus short-term trend following. But look, Jerry, you lead off. What topics do you want to speak about tonight?
Well, actually, I obviously really enjoyed your conversation with Niels, and I tweeted a lot of those, and they were really insightful. So I want to start out by asking you some questions about that. And I I'm embarrassing myself because I like came to this revelation, and that number one, we've got to continue talking about vol targeting. Yeah, so that's kind of a bummer. But um, I I think that you and Niels may have understood what was going on with the non-classic trend followers better than me, and so it just sort of hit me recently that I haven't been articulate about and didn't really dig deep enough to sort of figure out what they were saying and what they're doing. And just to remind everyone, like, so I've been this anti-vol targeting person, and that's the way I would describe it. Vol targeting is low in sample size, and it makes you trade larger. You're taking smaller profits, so you have to trade a bit larger, which is fine as long as vol targeting and that sort of um, management of your risk is robust. And then I sort of changed into, well, it's like vol and correlation management. There's more to it than just vol targeting. It's really volatility management, correlation management. They're doing lots of things in there. And then Neil started calling it dynamic rebalancing. And I was like, not really picking up on if he meant something more than just vol management and correlation management. And then I thought, oh, wait a second. I think it's way more than that. Um, and then I thought maybe it should be called dynamic portfolio or dynamic portfolio rebalancing, because it's really the whole portfolio is being impacted, if you wanted to do it every day, by increased correlation, increased vol. Um, and then I got to thinking about how Niels has described Dunn and others probably, that they don't use stop losses. And so I was like, yeah, of course, they can't use these stop losses because they don't need to use it. If the portfolio starts losing money, or if certain positions start losing money, you can cut back on those positions, or you can cut back on the whole portfolio. It's this constant adjusting of trades, buy a few, sell a few, to target this volatility. And so I guess they have to work in some sort of relative strength, or each position might have something to measure its trend. Is it a breakout, or is it a moving average? But it's yeah, I'm getting kind of confused. So I think that when I keep saying one entry, one exit, and a stop loss, and I envision that they are um, reducing those positions, like I would say, okay, I'm one entry, one exit, and a stop loss, but I'm going to reduce those positions if the volatility increases. So if my yen increased a lot, I would get rid of some of my yen, and then I go back to one entry, one exit, and a stop loss. And so this is nonsensical to them. They're not doing that. It's they're not using one entry, one exit, and a stop loss, and they're not reducing these positions. They're looking at the entire portfolio um, and massaging it almost every day. And I think that what you were saying on the podcast, Rich, is you were describing um, situations and patterns and convergent type trading, and saying that they're prescribing too tight of a path. And if this path in the future doesn't look like the past, then they're going to kind of screw up some of these trends, where our style is way looser and we're not doing hardly anything. And we have these sort of wide stops. So it's not just if your stops are wide or if they're close, and that's not loose pants if they're close. They've taken it a step further to where they're really, certainly looking at past data and seeing how much of this massaging of the positions would impact the historical trends. And I think what you're saying, well, you didn't really say this. I guess this is my question. But don't you think that this strategy of volatility, correlation, no stop losses, just every day sort of figuring out what this perfect portfolio could, how you could trim it up or increase it a bit. Don't you think that is as well paying too much attention to this historical patterns that may get them in trouble in the future? So it's not just the sample size that may be an issue, which we don't even, I couldn't even tell you how to count the sample size, but it's more, this sort of trading is also possibly too dependent upon historical results. And then, another thing that they're doing too, which is helping their performance so much, which is when these trends get going, like they have been recently, and Rich and I are sort of stuck with our trade level, and we're not taking advantage of increasing our positions all the time, current position to new positions based upon the new AUM that keeps going higher and higher. You can see how they're making a lot more money, and it would be much better to pay attention to use the current AUM and ratchet up these positions as you continue to make more money. And then, of course, what they do is if you start to see this drawdown, they feverishly reduce these positions very quickly as you got trend reversing, you've got volatility increasing, correlation might be increasing. All right. Hopefully you see where I'm going with this. What do you think?
No, I agree, Jerry. And so the way I see this is that not all trend followers are alike. Clearly, there's a spectrum of different types of trend followers. So I would regard you and me, Jerry, as what I call these outlier hunters. I think we are, let's say, on the one extreme side of trend following, we've got the outliers. And on the other side of trend following, we've got those techniques that are also targeting convergent trends. In other words, segments of mean reverting cycles, those sort of things. So there, there's two sort of there's these spectral ends of trend following, and as you get towards the convergent side of trend following, you're becoming more and more reliant on the historical backtest to give you information which you use for your risk management purposes. So those style of trend followers are doing things like an exceeding focus on correlations in the portfolio because they are using the historical relationships of price of the portfolio, of the constituent return streams, as a means to manage risk at the portfolio level. So effectively, their models, therefore, develop these thresholds of maximum and minimum risk tolerance, and they've got to stay within those thresholds. So they're continually massaging their portfolios to stay within those threshold tolerance levels. Now, on the other side of the spectrum, the outlier hunters, they have very little information to work on. They don't have any sensible information drawn from a historical backtest that has any meaning. There is no stable mean. There is no stable standard deviation range. In the outlier region, it's information deficient. So what we do, as opposed to those that sort of say are on the more convergent side of the trend following spectrum, we don't use history as a basis to develop risk mitigation measures in terms of correlation, the broad use of Sharpe and all of these metrics. We avoid that because we recognize that in our information deficient region, price can do anything. There is no predictability about it. There is no stability about it. There is no single mean. There is, multiple means. There's multiple standard deviation ranges. There's this chaotic behavior. So what we do instead is we use our system designs as a means to mitigate risk. So what we are doing is we're using the initial stop and the trailing stop as risk mitigation measures. Those people lying on the convergence side say, hey, we don't need to use a stop. We can use our knowledge of correlations, and we can use our knowledge of how to massage our portfolio to manage risk. And if we start using stops, we start influencing our P&Ls negatively because there is no need for these stops because we can, with fidelity, manage our risk thresholds by virtue of what history is presented. We're saying, well, we can't do that in our world because it's chaotic there. So we've actually got to use physical physical constraint mechanisms to mitigate adverse risk. Also, we don't use any form of profit target because we don't know how far that profit is going to run in that chaotic tail region. But the convergent trend follower might be tempted to take profit off the table because they say historically trends, it's got to now an extreme level where historically my back test is saying from the historical data, take some profit off the table. Therefore, I'll entertain notions such as volatility targeting or dynamic position sizing, what Niels refers to as a means to sort of mitigate my risk. Now, I'm not saying that either are wrong. I'm just saying that in our world of outliers, the reason we are attacking these outliers is that philosophically, we understand them to carry the most degree of beneficial change if we can catch them successfully. In other words, we don't mess around with the small change. We're going for the king hits. And we recognize that the dominant impact in the long term of our total portfolio growth is based on that handful of massive outlier trades. But the other side of the trend following spectrum will say to themselves, hey, we're prepared to sacrifice potentially some of those outlier trades to catch some of the meat that exists in the bulk of the distribution with more the convergent trends. We'll actually entertain ideas of counter trend strategies. We'll entertain ideas of putting sort of different trend models that sort of flavor it up with degrees of convergence to draw some of the alpha from the bulk of the distribution. But you and I are saying, no, forget that. We don't care about that minor change. We're not targeting that. We're targeting these outliers. So this difference in philosophy, I think, is creating this sort of spectrum of a myriad of different trend following firms. So really, when you talk about trend followers in our terms, and you and I say, we might be classic trend followers or whatever, really, I don't know how to classify trend followers anymore because there are so many people entertaining ideas that sort of are really out of our sort of region that we're even interested in.
And as we sit there and try to figure out, the sample size and not having too many parameters and not having too many rules and having looser pants, i.e., longer term look backs, it's
Yeah,
all.
that's to give freedom of movement. That's because we don't know anything. So we know that we're on a trend, but we don't know what that trend's going to do. So we've got to give it maximum degrees of freedom to allow it to do anything it wants to do, provided it's not significantly adverse to our objectives.
And it's almost like that this other style has no limit to the amount of rules and the amount of trades. It's if correlation needs to be reduced, damn it, we'll reduce it. If volatility is too high, we will do it. Now, this back test, their
That's
rules and are um, divine, are created from a back test. So they've just thrown all of this computing power and all of this desire to have this smooth equity curve, and they throw as many rules at it as they need in this back test, and then they come out of it and say, here it is. And this whole idea of sample size, it makes no sense. One entry, one exit, and a stop loss. What are you talking about? This is putting computer power and coding and saying solve this problem using 50 years worth of data, so we can create this much
That's it.
smoother.
It's highly statistical. It's well beyond anything we ever use. It is highly statistical. I'll grant them that. It's clever. I'll grant them that. However, it's of no use in our world of outliers, but it is probably of use to them in their, the bulk of the distribution.
Now, I think they're more willing to say, well, there's one way of doing it, then there's another way of doing it. The way that I look at it is is not something I want to do. I'm choosing not to do it. They're not. If we're subject to the same facts of the way the markets work, then they're subject to the same ones as well. And so we're saying we don't believe that there is enough information. We do care about this sample size, and so either they're right or we're right. And maybe you're not willing to say that, but when you say things like, and this is just a brilliant quote. The more prescriptive your design elements are, the more system parameters and variables you have, the constraints will restrict the degrees of freedom of price. You are more prescriptively defining how the trend needs to perform in the future. Now, to me, that's a perfect description of this other managed futures way of trading.
Yeah,
And
and that's what I was getting at.
is it just a fancy way? All right, here comes the big question. I'm putting you on the spot. Take a drink. Is this just your way of saying overfit?
Yes.
Thank you.
And I want to say that I like the idea of Jerry very much when he said that we must take from the backtest as least as possible. So we must take the main things from the backtest, and I think we know these main things, what they are, our drawdown, our so on and so forth. How we can capture the trade. Did we look at the backtest and we understand could we capture the trend or not with these parameters? So I think the main things, and we know, and it gives us the opportunity to have a more clear sample size, a more clear backtest. And of course, it gives us a probability that our backtest on the paper, on the computer, of course, will be the same as our execution. But if we have a lot of fancy parameters, from my point of view, it may be some surprises when you will execute this. And really, the future is not the past. It's very, very, very important to understand.
Well, I'm just going to keep doing what I do, and I'm looking forward to comparing this more pure trend following with what they're doing. And it makes me feel a lot less competitive too, because it's just so much more than what I'm interested in doing. And so it's not even like competing against me, really. It's just two different strategies, two different ways of doing things. And I'm looking forward to see how it performs in the future. But I do think we're seeing the benefits of their strategy, which is really outperforming. And I think a lot of it has to do with this sort of like trade level is the current equity, and they can keep trading larger and larger, and then ready on the switch though to scale back very quickly when the trends change, the vol changes, and you can just wipe out a lot of positions very quickly and preserve a lot of these profits. So I really think that they're getting a lot of positive feedback from this period about how wonderful their systems are. I just feel like I need to listen more carefully when people, like Niels is saying, like, we don't use stop losses. And you're like, okay, what? And then we kind of dynamically position. It's the dynamic rebalance, dynamic positions, even dynamic portfolio. It's all of this wrapped into one thing that has nothing to do with these discrete one entry, one exit, stop loss trades. And it's very fascinating to better understand it. I don't think I fully understand it, but I'm looking forward to uncovering more little nuances. What do you think, Alp?
Hello. Hi Jerry. Hi Richard. Hi everyone. This week actually, I I did code a long-term system on my end. So this conversation, my input could be more relevant, and I understand what is going on in your world. And you know, the code base is much simpler, I would say. When I compare the short-term model that I'm trading versus the long-term model. The long-term model, I say, is 1,000 lines. Pretty much anyone else can put together. The short-term model is around 30,000 lines, so it's just a beast. It's just because you have a code to be able to do everything else. Because it is taking 50 to 100 trades per year, the long-term model, So you can do a lot of things manually to be able to compensate for that number of trades. But when it comes to the short term, it's just you know, as a solo trader, I'm doing the data science. So there are lots of times that I am in the data looking for the bad data, bad ticks, you know. So there's that element. So there is lots of technological side to be able to trade with the algorithms all the time. And of course, it's a numbers game, it's a numbers game. So so whatever you do, and the interesting point is, so we all have this mathematical expectation, and as long eh, you know based on my experience with this trends, now I've called it this long term, there is the short term. uh, Everything else is making money with the trends, and when it comes to this the other trends, so there's a third bucket. So I trade short term, and people like yourself and Richard are long term trend traders. And there are some people trade through charts. Mike Shell, if I'm not mistaken, is doing that sort of stuff. And there are other people like Absolute who actually uh, incorporate an element of mean reversion properties into their trends. But if I take a step back, I can say that on the moment you start to trade trends, you're making money. You know, that's probably the very big enlightening to someone else who's coming into this world and scratching his head and asking, how are you going to make money on a bear market where everything else is falling? Well, you start trading the trends and everything else is going to go your way to start with. And when people are talking about these short-term models, of course, Niels is asking that question to the guests every week. And the answer is, people are usually talking about, this 40 to 60 day look back periods. And actually, the sort of the short-term trend trading that I'm doing, which is, one entry, one exit, one stop, is on an hourly bar basis. So it is working, but it is working on a quite granular level. And I have spent years on testing 1 minute bars, 5 minute bars, and ended up trading hourly bars. And these stuff all works. It's just about finding a lot of technology. So you need to manage your way around the technology, and you need to find a broker so that the bid ask spread and the costs that you pay actually are not too much. And when I look into these long-term models that you're running, of course, the drawdown is the obstacle, right? Now, what I have coded, and I've tested this for the 30 years, the model is making around 25 to 30% with drawdowns, 30 to 40%, basically. And and even if I push the risk, maybe the drawdowns may go a little bit more higher. So how are you going to manage that drawdown, isn't it? So that's at the heart of it. So you're going to address that, and that's why the other people are going through these hoops and they are overfitting, as Richard has said, and doing less effective things to be able to doing less robust ways. But overall, I think my message would be just trade the trends, whatever suits you, whatever you find easy, and you're going to make money. Thanks.
By the way, Richard Toll said his ideas about this. That, of course, all the in the previous episode of Top Traders and Unplugged Systematic Investor podcast, that all types of trend following trading in all time frames, they capture the trends, they make money, but have a problem, and we all understand this here, that there is a lot of noise in the short-term space, and of course high costs. And Richard said this, and I think that I have said before that if we have some filters, a lot of filters in the short-term space, maybe it will improve the short-term space. But I don't have an exact answer to this. Regardless, I was a short-term trader for many years. I don't know, because I have tested different filters. And of course, the rule number one here, it's not to filter you, or like Jerry teaches, not to filter out from a big trade in a short-term space or long-term space, any space. You must catch the outliers you are hunting for. So, another type of filters, I think. So, maybe it's will improve, but about drawdown, I did a lot of research here, and maybe in a long-term space, it's my own opinion, but no, I think so, that we have a drawdown from the high. We have a big drawdown from the high, and some people may think that it's a big drawdown, maybe, but it's not in fact. And in a short-term space, we can see also if we do if we do a good back test, maybe, and I have seen in the practical side this, we in a short-term space we can face also very big drawdowns, especially if we don't understand how to manage risk in the short-term space. And I have said before that in the short-term space there are another type of managing risk. I mean that if you risk, for example, 1% in a long-term trade or 50 basis points, it's not the same that you risk this 1% or 50 basis points in a short-term space. It's very different situation to have, for example, 10 trades a day with 1% and 10% minus, and 10 trades a year, or maybe 10 trades years, not year, but in 3 months. It's a very big difference here. And so maybe good filters can be a decision in the short-term space, but I don't know this exactly. It's only my idea. I didn't come to a exact conclusion here.
To let you know, I don't use any filters on the short-term trading. I take all the trades. Only I use correlation, so that's why I trade thousands of trades. And the short-term trading with the hourly bars or minute bars happens with fully automated systems. So I don't recommend anyone else to trade short-term manually. So if you're gonna trade manually, trade long-term, take those 100+ day breakouts, and you're going to have very good returns. And your only problem is just high drawdowns, but they are manageable if you risk small. And happy days. Thanks.
Hi guys, how are you? The problem with this chat is that you get a good question in your brain, then you start listening, and other questions start to pop up, and then you forget the first one. But I want to ask you if you think that, in a sense, short-term trading is like volatility targeting, in the sense that when volatility rises, you start to zigzag, and to lose your capital, and then you reduce your positions. So I know it's not directly because there are other tools used, but if you think that the effect is kind of similar. And then also something that is more high level, so to speak. Jerry, you said that these strategies were clever. And when you're doing long-term trend following, it's like you're more trying to manage your emotions instead of being clever, at least in my head. But do you think that cleverness, so to speak, shouldn't be rewarded in a sense, or that cleverness doesn't have value in itself, or has little value in itself?
Well, do you mean value at being more aggressive at trading and reducing positions, increasing positions, having more entries and exits than one breakout and entry and one breakout exit? I mean, I do what I do because I think it's more robust. There's a sample size element to it, and if I thought I could get away with this type of trading that the bigger firms do, that we've been talking about, then I would definitely try to do it. And so I just don't do it because I don't like it, and I don't think it's the correct way to trade. However, as I've been listening to Richard talk and thinking about what I was saying, it I don't know what I'd like to hear Richard's response to this, but um, it's kind of like every knowing what's going to make you healthy and not healthy, and so you don't work out and you don't eat healthy. You eat a lot of chocolate or sweets and a lot of red meat, and you violate all the rules. And then when you go to the doctor, he says, "You're fine. You're perfect. You're better than all the other patients I have that work out a lot and watch their diet." And so I don't see any downside to these other managers. Now, if you would listen to Niels's podcast, he would say a lot of the times, I don't see a difference. I don't see a difference in performance. Richard and Jerry continue to talk about this classic way, and then Dunn is dynamic rebalancing, positioning, whatever, and everyone else is doing the same. Dynamic can kind of cover, a lot of things that are going on with these rules, which I think is the way to look at it. There's a lot more going on than I thought. And I would come, and so I would listen to Niels and I'd say, yeah, he's correct. Now, how can we both be right? And I would say it's back to him. Okay, you're correct. However, no one really of any size is continuing to trade one entry, one exit, and a stop loss. So you're comparing what Richard and I are saying, but there's no track records out there. Um, Mine, but I don't manage a lot of money, and I haven't always been consistently trading this one entry, one exit, and a stop loss. And so I would say to him, you have nothing to compare to. And his response was usually to ignore me and continue to say the same thing. And so, but I think that is really the answer, is that, we don't really see, I sort of look at my strategy of trend following as comparing it to the S&P 500. We know the rules. They're not very sophisticated. No one can really beat it that often. And so the S&P 500 way of managing a stock portfolio is the one number we see every single day, and everyone compares to it, and very few people can outperform it. And this is what I predict for the future. I'm going to continue doing it. You can see my numbers, and you can see other numbers, and we'll see who wins. And I think that I think it's going to be difficult to beat this classic way of trend following. But if I'm correct in being so intolerant of this other way of trading, and I'm on record as saying the only reason I'm against it is because it's not as robust as what I do. Well, where is the evidence? I mean, they're kicking ass this year. And these are large firms that have been around for a long time, doing fairly well. And maybe my strategy would have done better than theirs. We don't really know. But it doesn't seem to be impacting them. And so this lack of robustness that I keep talking about, you need to finally see some reduced performance and some consequences for this lack of robustness, which we don't really see. They're thriving, they're staying, they've overfitted, they've fitted to the past. The trends in the future need to be more of a certain way than me with my loose pants. But where's the negative impact? They're really kicking ass this year.
Yeah, but I actually find there's a degree of separation that's occurring where, I don't always like referring back to Mulvaney, but I believe the likes of Mulvaney and the likes of Dryce Research Corporation, the likes of you, Jerry, I believe are what I would regard as these firms that are specifically targeting outliers. The balance, I think, we've had a history for the last 20 years where over maybe 10 or 12 of those years, we've had these massive quantitative easing practices, and we've had massive mean reversion over the 10 years. And what's happened is these big firms have been sort of the beneficiaries. What they've done is they've decided that they want a piece of that action. So they're not catching outliers per se. They might be catching a degree of these outliers, but what they are catching are trends. So, if you imagine a short-term trend follower, in that short-term trend following space, they are capitalizing on not just outliers, they're also capturing trends with negative serial correlation or mean reverting cycles of trends, which is giving them some positive performance. So provided the regime is favorable to that, they will perform well. So I believe that we're starting to see a dispersion now, particularly in the last 5-6 months, where we're starting to see the likes of Mulvaney actually accelerate beyond the returns or the risk reward metrics of the alternative program managers. We're starting to see a trend following fund that has a philosophy of specifically targeting outliers. They're long-term in nature. They're using breakouts. They're adopting, the philosophy that we're saying is capitalizing on this uncertainty associated with these tail regions. And so if this regime continues, so if uncertainty continues, or if, things like central bank intervention is less powerful than it has been before, or, as we go into this quantitative tightening where the central banks are sort of more loath to sort of intervene in the markets, I think we are going to have this regime of possibly far greater percentage of outliers. And I think we will get a separation. So you can't measure these things in decades. You've really got to go over the long-term data horizon to start seeing the weaknesses of these programs sort of start falling apart. And we saw that with the Fort programs. Fort had a 20-year track record, which was suggesting that their trend following program, what they were calling trend following, was doing incredibly well. And we all believed at that stage that they were trend followers. But clearly, the cracks have now shown in Fort programs across the board that they were doing something clearly different. But it takes a long history to start seeing the sort of the weaknesses, the risk weaknesses start to sort of take shape and create this dispersion.
That's exactly what Richard Dennis told me in 1983. So I think that we have to go with that. And once again, I think the worst case scenario for for Richard and me is we'll be just as successful and we'll have a bit more of a drawdown. If we figure out in the next life, God comes to us and says, hey, vol management, vol correlation, dynamic balancing is fine, then we'll say, oops, okay, we were too conservative. We could have made more money, or we could have had less of a drawdown, less volatility. But it's not like we took a path that's more conservative and more respectful of the math and the sample size, which is the only thing that we can really rely on. I think sometimes I get into trouble by not making sure I preface all my statements with, hey, I believe this because of the back test and a proper back test. I don't just out of thin air say, okay, hey, I think my trade level calculation would be a good idea. No, this is all dependent upon what I've wanting to be conservative, wanting to have a large sample size, wanting to trade as small as possible and have as less risk as possible. And it's a result of a proper back test. And I do think that, when I apply a vol management to my systems, if this means anything, it makes me trade a little bit larger. So my 20 basis point loss now needs to be 30 basis points to earn the same amount of money. And so obviously I'm not going to choose to do that. I'm going to transfer that risk away from capital and into volatility of open trade positions. And I think that's a smart way of doing it. So anyways, I'm rambling.
It's interesting when I've done some work on comparing short-term timeframes to medium-term timeframes to long-term frames. One of the things I did was Perry Kaufman and uses this concept called the efficiency ratio to look at the signal-to-noise relationship in a price series. And when you, for instance, take 200 bars of data on the minute time frame, or 200 bars of data on the hourly time frame, 200 bars of data on the 4-hourly time frame, and you start stepping out, you then go to 200 bars of data of daily, 200 bars of weekly, 200 bars of monthly. And then on the same markets, you measure the signal to noise ratio, you naturally see that as you migrate up to the higher timeframes, the signal to noise ratio becomes much more pronounced. So that's telling me that the impact of outliers in the time series is what the reason we are stepping out to the medium to long-term timeframes. So yes, the market is fractal, but this does not mean that the distribution of outliers is the same throughout the distribution of the signal within that market data is evenly distributed. I believe, a bit like Perry Kaufman's methodology, that the impact of price is a combination of participant behavior. And so when you're looking at 200 bars at the hourly time frame, the most likely participants who are participating over that 200 bar journey are dominantly speculators, dominantly those people with high frequency trading methods that are predominantly focused towards convergence. So in that particular 200 bar time series on the hourly time frame, I think the behavioral impact is being dominated by a convergent behavior. But as you step out to the daily timeframes, 200 bars, that's almost a year's worth of data. You get a much greater participant mix of different forms of investor, hedge fund manager, bankers, etc., high frequency traders, they're all in there. But the impact of the participant mix shifts in that the level of convergence dissipates. And within that, you get this battle between convergence and divergence. And I think as you step out to the weekly and then for the monthly, you then start encompassing the behavior of all participants, particularly over 200 bars of monthly data. All participants' behavior are represented in that. And I think that the participant mix is what is driving, or the behavior or the behavioral impacts of that entire participant mix is what is driving the dominant outliers. So when I look at a monthly chart, if I look at any of my liquid markets in my portfolio at the monthly chart level, all I see is trends. I rarely see convergent periods or long extended protracted periods of nothingness. They all seem to be influenced by trends visually. And that tends to me to say that outliers are the dominant impact driving the monthly time series. And, when you think from a fundamental perspective, you start saying, well, that makes sense because at the small scale, the impact of central banks and all of these things is effectively random in nature. But as you step out, you start seeing the economics or the fundamentals start driving that price. And I think that is being represented in the dominant price movements or the outliers dominating the overall bias of that price series. So that's something that one of the reasons I like stepping out to the medium to long-term timeframes, because I think we are actually getting a greater signal to noise ratio, a far greater signal to noise ratio in relationship to the level of outliers in our series versus the level of noise.
Just to clarify on that, when I look into my back tests and my trading on the hourly bars, my win rate, my hit rate is pretty high, I would say. So it's more than it's maybe 38 to 42% range. So it's pretty good. And the outliers are definitely there. So I'm capturing quite large outliers for the sort of trading that I'm doing, and the number of opportunities are large. So when it comes to the ease of trading these outliers, surely the short-term has the benefit of much lower drawdowns. So I'm even pushing my system to be able to have some drawdowns. Let me put it this way. You're trying to avoid it. I am asking for it because it's not coming. I'm ending up with this 10% drawdowns, 15% drawdowns. This year, my maximum drawdown was 25%, and I can well actually go well beyond that. But it is not coming. To be able to have more drawdowns, you're going to risk something else ridiculous. So, and you wouldn't want to be risking that much of your capital. So that wouldn't be a very good risk management. But overall, the tradability of the short-term models are very technology heavy. Of course, as I mentioned, these are just automated systems, no human intervention. In terms of noise, so that's why I don't see much noise. Compared to long-term models, I would say now I'm keeping an eye on both of them. These models are both having somewhere else between 35 to 45% ratio win rates, and and these are all one entry, one exit, and one stop models. So yeah, and in terms of the mean reversion trading, of course I'm not a mean reversion trader, Richard. You may want to think that in your mind, but that is not the case. So I guarantee you that I'm
Al, what I'm meaning there, Alp, is that at the time frame that you're trading, you are trading trends, and this is what I was saying to Niels. All traders effectively trade trends that are not selling options. In other words, they're looking for a difference between the entry price and the exit price to make their profit. That effectively is a trending series. But the question is it a mean reverting component of a larger oscillating cycle, or is it actually a directional outlier, which you find in the tail regions? Now, when you look at convergent models, you naturally find that convergent models have a much higher win rate and a lower reward to risk. So they operate around the 60, 70% level of win rate, but their risk to reward is usually around 1 to 1.2 or 1 to 1.3 or something like that. But for the tail hunters, they operate with a much lower win rate, something like, maybe 30 to 40%, but they have a much higher reward to risk. Now, what they're capitalizing on with their models are the nature of the tail properties of the distribution. They're working on the principle that with the tails, it is this enduring trend that's created through power laws, which is driving this significant directional trending series. And they're saying, I'm prepared to sacrifice my win rate to get a bit of that directional impact or that momentum. So whilst
yeah,
I totally understand you're trading trends, you are trading trends, but I would say that a lot of them are probably trends of a much bigger mean reverting cycle. None of us would say it's
but
mean
it's only
reversion.
in
It's
your
still trend.
it's only your mind though. That's the point. It's only in your mind, Richard. Neither the original turtles between 83 and 88 traded mean reversion cycles. They were mean reversion traders, nor I am. So so those guys like Jerry Parker back in the day, they were trading 20-day breakouts, and now I'm trading similar breakouts on hourly bars. But these are, of course, definitely capturing those outliers, and the win rate, as discussed, is somewhere else between 35 to 45. And the whole point is, so you go long and short, and where long-term models actually are losing money at times, I'm making money because I'm reversing it as well. And the point being is, every time frame has its own return distribution. So my return distribution actually, the outliers on my return distribution might well be sitting in your normal part of your return distribution. Okay, but I'm not trading a long-term trend trader's return distribution. I am trading an hourly bar uh, trend traders return distribution, and I'm hunting the outliers there. So there is no way that I am actually trading any mean reversion property. I'm cutting my losses short, trying to get as many R multiples for the 1 hour risk that I am actually risking there. And there are no filters other than the correlation filter. So in your models you do not use correlation, so I use correlations, but that's how it goes. So of course, on the when the short-term trader trades, a lot of things are happening at the world at that moment. Sometimes some of my trades are sitting in your return distribution, and sometimes it is sitting on ARC, this long-term buy and hold ladies return distribution. So be it. But this definitely, they are definitely not mean reversion trades in whatever time frame. Thanks.
I want to say about the noise, because I have experience, as I have said a lot of times before, in short-term space. And I want to say here that maybe 1 year you will not see a lot of noise, really, or 2 years maybe. But if you do it consistently, one day you will face the noise like maybe from engine of a jet. It's a joke, but so it will be a period with a very high noise, very very high noise. It will be maybe 1 month a year, but it will give you this noise can give you a significant drawdown. So it's my opinion. So if we are talking about trading in short-term space, and about I'm sure that the fact of the noise is an axioma. Of course we have that noise. Of course we have more noise. If we are talking about few years trading, we have much more noise. And when maybe theoretically, and I don't know the answer, we must think about if we want to be a short-term to trade. If somebody wants to trade in a short-term space, I think that person must think about reducing this probability of noise. But I don't know is it achievable or not. I don't really know it exactly.
Hey, hi guys, good to be here again. I got the discussion as it was after it has already begun. So if I'm picking a point you have already discussed, please excuse me. But this topic that Richard just touched on, the markets being fractal and looking at the bars at different time frames, looking at hourly bars or daily or monthly. It reminds me of a it may be a pet peeve only, but anyway, I due to this fractal nature, I find the breakout systems much superior than others when we're talking about trend following, because a max within the monthly bars will be the same as the max within the daily bars or the hourly bars or whatever. And whereas if we're talking about moving averages, depending on the way you're calculating your bars, it can get sloppy. It can yield different results. Do you have any, I don't know, any comment on that? Do you find the breakout system superior or not? What do you think about this?
I mean, on the short term, as I mentioned, usually it is you're on the 35 to 45% range, like any other long-term trend trader. The percentage is just there, and I don't see any additional noise really, but just reduced drawdowns. Just reduced drawdowns. Why you, instead of taking 100-day breakout, you're just gonna take 100-hour breakout instead of and there are some complexities around managing that time series data and sending those orders to the broker. But that's it. It's the same thing. You're already accustomed to taking that 100-day breakout. What I'm saying is, instead of taking 100-day breakout, just trade the 100-hour breakout. What is that so different? It is not. But the short-term trading that we are talking, and sometimes people are referring to, is never between 40 to 60 days, because in the past people have traded these 40 to 60 days, and they were working at some point and they stopped working. So when the parameters, so when a lot of people, if there would be a lot of people would be trading 100 hourly bars, maybe 100 hourly bars will stop working, and then you need to change the parameter set, and that is fine. So the model is robust: one entry, one exit, and one stop, and you're gonna trade it as long as it is possible. And where the moment comes that it is no longer working, you're gonna change the parameter set. So this is how it works with the short-term trend space. Thanks.
I think that changing parameter setting can be a big mistake in some cases, and I think that it's maybe here we can see a universal law that yes, short-term space stopped giving us good. They did not stop working. That performance get lower, and of course, I think that it will return sooner or later. But maybe I don't know. But I think it's not really maybe the best approach for me personally, because I decided for me personally to be like Jerry, like Niels, like Richard, to be from long term, from middle term to long term, because I like this approach most from all what I have seen, and I have seen not. I have seen a lot in the transformed space because of my research. And of course, I don't think that there is a reason to short-term space to stop working. No, I don't think. And maybe it is, maybe not. I don't know. Anyway, but I think that we have seen, of course, and Jerry told this, Niels told that we have seen that, for example, 200-day breakouts worked in 70s, and 200-day breakout worked today in the same maybe way. 1 year better, another year not so good, but in fact it works in the same range, maybe, if it's correct to say. And we are not seeing this situation, the same situation with short-term space. We see that short-term space started to give, maybe in a classical way as it was, it started to give much worse results in the way they were done. And changing the parameters every year or maybe every 2 years can be a mistake, because we don't know what we can see in the future
No,
month.
Oleg, I'm not saying that change the parameter set every year. I was just referring to the fact that what Jerry has traded in 1980s doesn't work anymore, right? The people have created a strategy called turtle soup, which if you wanted to go long with 20 and exit in the 10 days, 20 to 10 the breakouts doesn't work anymore. So you're gonna do something else. So that's the parameter set, of course, doesn't change in a year or two, but over the long run, it may change. So that is.
Yeah, let me get in here just for a second. So I was just thinking about some other things. This is going back a few minutes when Richard was talking, but Winton, they're on record as saying, "Oh, we're super long term." Very very long term trader. And I think David Harding over the years has mentioned some trades, like we were short natural gas or short gold for a year or two, and I'd go back and look at the chart and kind of see what parameters would keep me in that trade for a year or two, and I was like, yeah, they're super long term, and so I just kept forgetting that part of this loose pants is not just the look back period, which you figure someone like Winton with a lot of money under management, a lot of these large firms, oh yeah, they're tremendously long term. However, another part of tight pants but we have 1,000 parameters and 1,000 ways of continuing in that long-term trend to increase the position, decrease the position. And, we're sort of famously, or I'm famous for saying, like, well, you're taking smaller profits. You're not participating in these long-term trends and outliers like I am with the volatility and with the drawdowns, but you're not doing that. And they're very quick to say, oh, yes, we are. We are still long this market. We've been long forever. Oh, yeah, that's right. You just keep trimming it and reducing it, then increasing it, and relying upon the speed of, oh, crap, now we have the big position on at the very high. We've just been increasing it because vol was slowing down. Now we've got to get in here and unwind it very quickly, and that's what they do. And so they are participating in these long-term trends. They do have these loose pants in that particular way, the 200-day, 300-day breakout, whatever, maybe longer term than me, but not with this full position that I come in with that I haven't changed in the past year or two. So it's the time frame and it's this overfitting more rules, but they certainly would not agree that it's overfitting at all. It's they would challenge, like, who are you to tell me it's overfitting? Who are you? Let me see your academic credentials.
Interestingly, I think there's also a relationship between your lookbacks and your levels of diversification. So, as Bruno pointed out, one of the reasons that breakouts are great is that, on the different time frames, on the daily, the weekly, the monthly, or whatever, the breakout level can be at a consistent location. That's a really valid point in my opinion. But aside from that, one of the things I'm wondering, say for ALP with the short-term models, how many markets you're diversifying into, and how many can you get to? And is this it? Do you find that your models are targeting the unique characteristics of an individual market, or are they targeting the universal characteristics that can be found across all liquid markets?
At the moment, I'm trading 75 markets. So, I'm not concentrated in any shape or form. And the only filter that I do use is a correlation filter. And I may choose not to use it like you do, guys. And if I do that, I end up with 5,000 trades. And I end up with a higher drawdown. And
Okay, so correlation is effectively filtering out a lot of your trades?
Yes. So that's the only that's the only filter that I'm using. That's it. And and I'm finding it extremely helpful for what I do because it is taking the drawdowns quite down and reducing the number of trades as well. And on the short-term space, the execution is a huge problem. The application of this strategy on the short term is a huge problem. So if I can make same amount of money with less trades, I would take that, even though we discussed the more trades are better to be able to capture more outliers. There are my main concern is the the operational problems where this code is going to work without any problem and everything else. So that's why I have introduced that correlation filter, and I'm very happy from that, to be honest. And so the markets are definitely very. So I trade bonds, commodities, stocks, forex, and crypto. So as diverse as you may want to trade, to be honest. Thanks.
No, thanks, Alp. That really helps. So, because I was wondering, I knew you had to be doing something different, because when I do my workflow processes annually, when I evaluate my systems, so I basically redo everything on a yearly basis, looking at very long-term data sets and looking at their multi-market potential. So I don't restrict the variables to exclude short term. I actually allow the variables to wander from really short term right up to very long term. And at the end of the workflow process, it naturally falls. So provided it meets what I call the multi-market capability, in other words, the universal characteristics of the portfolio I trade, provided it does that, then it passes the test. However, if I allowed my workflow process to basically respond to the unique characteristics of individual markets, I'd get very good results on my individual markets, but they wouldn't have this universality. And this is where I believe that what's happening when you're looking at the short-term models is I believe you are borrowing from the bulk of the distribution with your edge. I'm not saying that the edge isn't there. I'm saying it is there, but I'm saying it's slightly different to what we do. So, I admire that you've got short-term models that work, because I've never been able to get my short-term models to work because I'm not applying this correlation filter. And as you've found out, as I obviously do with my simple models, is I find that there's a hell of a lot of noise accompanying my trade results when I'm going down to the short term. But therefore, I need some secret source. You've obviously found it with your correlation, which has filtered that degree of noise out to reduce your drawdowns. So, yeah, I admire what you've done, but it's definitely different to what I do.
And don't forget, it's hourly bars. So um, you've got to get that good data, and it's not it's not daily bars, short-term daily bars. So I can see how it works. I've never gotten hourly bars, but it does bring up a question I wanted Alp and Richard to weigh in on, which is where I always preach that the first and foremost duty of a trend follower is no type 2 error. No type 2 error in that we miss a trade. Type 1 errors where we take a trade and lose, we've got that covered. We've got the stop loss. The type 2 error, we have nothing. If we miss it, we miss it. And we're going to be have the bad luck of missing the big ones. We're not going to miss too many losers. The way the world works is if we decide not to take a breakout or take a trade, we're going to miss a big one. Now, that is critical for my time frame. But obviously, if Alp is going to use correlation and not religiously apply one entry, one exit, one stop loss to the hourly bars, he is going to miss some good trades. He's going to say, not going to do this trade. If I didn't have this correlation filter, I'd do 10,000 trades. That's too many. I need to whittle it down. And so I'm not going to take this heating oil trade. I'll take this crude trade. And then heating oil makes a lot more money, but he didn't take it. Now, since he's doing so many trades, would you say that the problem that we would have with the type 2 era, that Alp is not really going to have that, because as soon as he misses that one, another one's right around the corner. Unlike me, I don't have outliers right around the corner.
Actually, the answer to that question is yes and no. In September, I missed the carbon emission trade, for instance. So that's why in September, I've closed 1% or 2% down. So in September, that was the only trend that was making money, to be honest. So, but in some other months, there are many trends are making money, short-term trends. So if I miss one, it is not that big of a problem. So, but if you compare the overall pain of losing or the type 2 error, of course, as a long-term trader, because you're taking 100 trades, the proportion of 1/100 is going to be much more painful over 1/1 thousands of trades. Thanks.
I needed you last week, Jerry, when they were talking. Niels posed a question. He said, "You're always talking about type 2 errors, but what are type 1 errors?" And to tell you honest truth, I just forgot. And that's because I'm so focused on this type 2 error. I think that's really important in our world of trend following. But yeah, I think you've politely reminded me what a type 1 error is. It was a good instructional lesson.
That's funny. One out of a million podcasts, I'll have something to add or something to help you with, Richard. So I'm just so
Many thanks.
thrilled that you struck out on that one. That's why I think it's so important to remind everyone that I bring up a lot of little irrelevant issues in some of these podcasts, and I would really appreciate more of a pushback. I usually don't get enough of a pushback, because it's just like silence sometimes. And so I'm kind of never in favor of reading or these studies of, I studied, I could just enter randomly. And I'm like, okay, so what? I mean, I'm not going to enter randomly. and I'm going to care about my entries and exits in the same way. But exits are more important. Whatever. I mean, maybe. I certainly think that the most important thing on day one is the entry. You got to put the trade on. If you don't do the trade, it's the biggest mistake you're ever going to make. I didn't think I needed to whatever, buy canola or rapeseed. It's in my portfolio. I didn't buy it. I'll get the same. I mean, I've done this before. I didn't buy silver in 1987 because I was like pissed off about something and I just bought gold. And silver doubled and gold sat there. Well, there you go. Nice instruction for Jerry. He needed it and it really cost me a lot of money. So that's the most important thing. The entries are important. We have enough time in our day to spend a little bit of time with doing it's because the entry is just this breakout. So I pay attention to it. I want to make it better. I have a little filter that speeds up my trade or slows it down a bit based upon the market consolidation, let's say. And so the reason the exits seem to be more important is that on any given trade, the difference in the P&L from system 1 to system 4 can be a lot different, right? Because system 1 is shorter term, it got out, the market crashed. System 4 didn't make nearly as much money. But you know what? Over the test period of 30 or 40 years, system 1 and system 2, with very different breakout exits, make the same amount of money. So yes, it's true on any individual trade or month or week or year, system 1 may outperform system 4, but over a long period of time, they make the same amount of money. System 4 has its day in the sun where the initial sell-off where system 1 gets out, system 4 stays in, and it just so happens that a majority of those trades in that particular time period went on to make new highs, and system 4 crushes system 1. So all of these things are irrelevant. Have multiple systems, have multiple entries and exits. Find a group of systems and a group of parameters that basically make about the same amount of money.
What I don't understand is why everybody is so definite about the classic short-term periods not working anymore. Because I know that they don't work for a lot of time. They didn't work for a lot of time in the same way, like, for example, I don't know, the S&P didn't work for 20 years in the 2000s or trend following in these later years before the COVID. But what is the logical reason to say that the original turtle periods is not working anymore and it won't work anymore, and the long-term systems will work and the short hourly systems will work? I mean, I'm not saying that it isn't so. It's just that I don't know why everybody's so sure that that is not working anymore. I mean, I was thinking about Toby Cravel's system of trading, opening gaps, etc. And they say that that doesn't work anymore. I don't know that, but maybe there is a reason in terms that there is a global trading, there is a night trading, so the gaps are not there anymore. That makes more sense to me in a way. But see, if markets are fractals, why is that everybody is saying that the typical turtle short-term system of 20 to 40 days, etc., is not working and it won't work anymore?
Well, Codger, the market is fractal, but we've got to recognize that it's asymmetrical. In other words, it's a fractal is a self-similar pattern that is applies at all scales. Now, the markets aren't actually like that. They've actually got a finite lower limit where the tick or the individual tick that comes in is the base level. It's got open-ended at one side and it's closed boundary at the other side. So it is fractal-like, and this is what Bill Dreiss found with his fractal wave algorithms. If anyone traded fractals and knew about fractals, it was Bill Dreiss, and he found that it was his weekly systems, his weekly look back, that took the greatest advantage of the fractal patterns in trading trends. Now, I personally think that markets are adaptive in nature, and it's a participant mix. The behaviors of the individual participants how they shift over time that makes the nature of patterns change, the nature of trends change. So if, for instance, we get a regime where a convergent participant flourishes, that is to the detriment of trend followers who are targeting outliers, because the convergent pattern is the dominant pattern over that regime. There are these two forces at work. There's forces of convergence and forces of divergence. And basically that therefore makes price move up or it makes price move down. When you get sort of an equal balance of representation of convergence and divergence, you get noise. There is no sort of overall bias in a series. But when you get a dominance of convergence, you get a dominant, what they call a negative correlation, a Hurst coefficient ranging from 0 to, I think it's 0.5. At 0.5, you've got noisy markets where the balance is fairly equal. As you go from 0.5 up to 1, you get divergent, where we get positive serial correlation. That's what means that a high is followed by a high, is followed by a high, or a low is followed by a low, or is followed by a low. But in the convergence series, you get a high, then followed by a low, then followed by a high. It trades around an equilibrium. So the impacts of the shifting participant mix makes the market wander between periods of convergence, periods of divergence, and periods of noise. I think that when you're looking at why doesn't the trend following turtles method work from the 1980s? Well, the parameters still work, but the variables don't. So what's changed is the nature of the trend form. It's got a lot more noisy. And that's because I personally believe that the participant mix has altered. We've got much more high frequency traders than we had in the past. We've got this blossoming of convergent methods that are very sort of, they're using high levels of statistics, high levels of computers. This is shifting the participant mix to change the nature of the trend form. Back in the 80s, there was a lower level of participation in the market and trends were much more sort of easily defined. But this time, trends are much more messy these days. You need looser pants to capture the trends of today. So that's my personal opinion and why there's change, why things work in certain regimes and certain things don't work in other regimes. It's sort of about how the level of participation behavior changes.
I want to put forth a couple more comments on that, but I'm just totally copying what Rich has said before. But before I do that, I wanted to say that, I think in the back test, I don't think that the old turtle systems work very well. Now, but remember, the old turtle systems use daily bars. And I think what Alp is trying to get us to see here is that hourly bars, short-term using hourly bars is far different from short-term using daily bars. And so I'm pretty sure that we saw some evidence in the late 90s when we were researching the old turtle parameters of 20 weeks and 20 days and 40 days, let's say, 20 days in, 10 days out, 40 days in, 20 days out, that there was enough evidence that for us that we needed to switch to longer term. And that's when I started looking at charts and seeing these long-term trends that last for a year or two. And we kept not participating fully in them because we kept getting bounced out. Then we did the back test, and it was an easy switch because we said, oh, well, as Oleg was saying earlier, the longer-term systems work just as well. They've always worked well. But I do remember Richard, a long time ago, saying something I'd never heard before about this, what's the problem with trend following? I was taught that the problem in the markets is there's too many trend followers. And I believe that Richard said, well, no, there's too many convergent traders. That it's not that there's too many trend following like us, there's too many unlike us that are impacting our trades. If you trade too short term, too tight of pants, you keep getting bounced out of the trade and it goes right back to the highs and you have to get back in. That happens too often. And I still think, though, at least 50% of the people out there who are trend followers still will say, no, there's too many trend followers, because they haven't heard Richard talk about his his philosophy of the opposite, which is too many convergent traders. And also, well, I need Rich to. I can only paraphrase this. I'm going to get it sort of wrong, but another thing that Richard talked about in podcasts this year, I believe, was the research done by JJB. I think that's right, about endogenous and exogenous trends. And I think it was something like these endogenous trends are responsible for 80% of the trades. And these trades have a tendency to last a year or two. And this is what this long term, another reason that we feel that this long term strategy is destined to win over time is because it is more focused and the parameters are willing to be adjusted to this reality that the majority of these trends come out of nowhere with no information, and they are revealed over time that may take a year or two. And these type of lookbacks that I trade, that's exactly what how they crush it, because they have a tendency to stay in a year or two. And these other trades, the other 20%, are the news comes out immediately at the breakout. It's a big, huge rally, and then there's a crash, and this is the um, exogenous type of trades. Did I get that right, Rich?
You did, Jerry. Essentially, what it's saying is that in the convergent landscape, there's this thing called the law of diminishing returns. But in the divergent landscape, there's a thing called the law of increasing returns. Most traders, considering supply and demand and all of these things, are concerned with the law of diminishing returns. This is basically a tendency of a market to want to reach an equilibrium state. So that's what a convergent trader is capitalizing on, this tendency of the market to equilibrate. But in the law of increasing returns, this is in regimes of transition between periods of equilibrium, where markets tend to want to diverge away from an equilibrium. And what these things are, they're reinforcing events, because what it's relying on in the convergent landscape, it's relying on lots of different traders having different models and doing different things, which therefore the impacts of those traders tend to equilibrate the market. It tends to eat the alpha from the market opportunities and make the market efficient. But in the tail regions, where we get the law of increasing returns, we're relying on synchronous behavior. And so what we find in this zero-sum game called trading is that in periods in periods of uncertainty, where markets start getting chaotic, you get a mass shift in behavior from convergent traders whose models are no longer working. And because the bulk of participants who trade are convergent traders, they're using things like, value investment, even the, buying equities, buy and hold, all of these things. Effectively, there is a convergent mindset adopted towards the behavior and practices that they do. However, and mean reversion, of course. So, and pattern recognition is another convergent method. It's relying on the historical signature or patterns evolving from a data set. That is a convergent premise, because it's based on the fact that these patterns will repeat because it's oscillating about an equilibrium. However, in these tail regions, suddenly we find this mass shift in behavior from convergent behavior, where suddenly these people find that their models are no longer working, and they're getting squeezed. And what they do is they, without realizing it, become trend followers, because they've got to abandon their models and they've got to adopt, either extract themselves from a trade. And what that does, the extraction from a trade, means that they reinforce the trend. So the behavior changes in this transition period, where suddenly convergence flips to divergence. And we've got this synchronous behavior of all participants starting to do the same thing, that's driving this directional movement and this tail movement to these massive anomalies, or these capitulation events. It occurs in times of stress, where we start seeing the bars get much longer, much wider, because no longer does the convergent method work. And so they're effectively becoming trend followers. So as more and more people start doing the same thing, it's reinforcing the trend. It's giving it a power law signature, which is therefore giving it this positive serial correlation. And that's what's driving that trend.
But Richard, can I ask you something? What about the buy and hold ETF, kind of S&P momentum? Where are they? Are they on the convergence side or the divergence side? Meaning that they are not, if I understood, they're not betting on the law of diminishing returns, because some guy like Buffett or other value guys, they are betting on that because they say, well, this is now cheap, I will buy it until it becomes expensive. But then a huge force of the market, which is the indexing folks, they don't care and they just go there. That's why many of those businesses are great, but they are super, super expensive. Where do they fall?
I think you've got to analyze the systems that everyone's trading. You've got to analyze what those systems are seeking to do. Are they seeking to trade a directional movement and continue trading that directional movement, or are they prepared to, are they seeking to sort of do counter trend to that primary movement? So if you think in terms of counter trend or trend, you can start defining what fits into convergence and divergence. And a lot of the equities participants, most of them have been buying the dips and selling the tips. Now, that behavior of buying the dips and selling the tips creates this oscillation. It creates this equilibrium. It's so you've got to analyze each strategy to see what they're doing. But from the ones that I've looked at, there are very few actual divergent techniques. That, buying calls and buying puts is a divergent play. Trend following is a divergent play. There's probably only a very small handful of other divergent plays, but the vast majority is based on this principle of convergent behavior. So, yeah, it's a tough one, Cordura.
But did I understand correctly? For example, a guy who's trading value is seeking is in the diminishing return law because he will buy until that equilibrium is reached and the opportunity is there no more.
Yes, that's right. So what they do is they say, here is what I calculate as the intrinsic value of this stock. Let's look at what current price is. Is it undervalued or is it overvalued in relation to my interpretation of that intrinsic value? So you can imagine that is a mean reverting play. That's a convergent play. It's assuming that if it's underpriced to that intrinsic value, they'll buy and they'll wait till it reaches that intrinsic value and then they'll sell. So that's a convergent play. It's not the assumption that price can continue to go on into infinity. They've got always this intrinsic valuation in the back of their mind based on their methodology for how they calculate that level of intrinsic value.
Okay, because then I think that people who are indexing to the S&P, maybe they're kind of divergent too, because they don't care about levels, they don't care about valuations or price earnings or liquidity, etc. In fact, the internal price of the S&P is given by active investors because those are the ones who set the prices, not the guys who buy the ETFs. So maybe they are that divergent too because they are not waiting for a mean reversion. They are just there, and they will, in theory, of course, they will always be there.
Yeah, can I comment? Hi guys, hi everybody. Very interesting discussion. So many things. I should have started writing down because I wanted to say and comment on things from an hour ago, and those hour ago things are gone. I completely agree with Richard's explanation of, and I hope you guys are giving this presentation an explanation as to what your edge is in terms of outliers and trend following and why trend following works and why I think trend following works as long as there are, to some extent, free markets that allow market agents to reflect general human nature. And Richard explained it very beautifully. I would add to that, human nature is convergent. Like, human nature prefers convergent trading, and we should be lucky and happy that most of the agents in the market that are taking our trades, the outlier trades, the trend followers, are actually the majority of the people. And we should be lucky that we're in a small minority. And I think Jerry and Richard should be even happy that they're even in the smaller minority of that minority about doing something that 99.99% of human beings find very difficult to do. So I wouldn't be frustrated about that. I would be lucky. I would feel blessed. So I would add, so to comment on the S&P 500, the S&P 500 indexing is very convergent. And it's convergent to the central bank's put for the markets. It's convergent because, yeah, buy and hold, just buy SPY, don't care. You're 30% down. Now it's the worst time to get out. Just hold on, it will come back. It always comes back. And lo and behold, yeah, wow, 10 years ago, my dad or whatever, if he got out, he would have been screwed. If he stayed, he's fine now. He's not up 10x. So the central bank put on the equity markets and on most markets, I would say, has implanted the pattern of convergence in 99.99% of investors on this planet. And since futures is a zero-sum game, not just futures, I would even go as far as to say, if you expect to make more than 5 or 6% a year, which over the 100 or 200 years has been the return, notional return on central bank inflation plus human productivity that wakes up every morning and goes back to bed, any percentage, any outperformance of that 5-6% a year that you would expect has to be taken from somebody. So if you expect to make 20-30% a year, you have to find and define who the suckers on the poker table are, from whom you will take the extra 15-20% that you target to make. And what Richard explained is that the majority of the converging, the trained convergent pattern seekers, who now employ even more computing power to find convergence on even smaller timescales, on 5 minutes, on 5 seconds, on 10 seconds, the more people pile up to these high, sharp, convergent, comfortable systems and trades, the more prone the system becomes to, when and if some noise kicks them out of that convergent range, the level of pain increases exponentially, not linearly. So there's the 5 or 10% that will get out, cry uncle, with a 10% drawdown. That will push the market even more out of equilibrium. Then there's the other 30-40% of convergent traders who are like, oh yeah, I was always buying this dip. So now they double down. They're down 30%, they double down. The market goes down 40% against them. And they're doubled down. They're out. They're out of business. Investors are out. They're kicked out. As they get out, and this is a huge amount of money, as they get out, they push the market further out of equilibrium. So on all time frames and in all markets, there's this devil of randomness that swipes out and kicks all these convergent, comfortable traders with high sharp strategies out of their comfort zone and creates the outliers in all time frames.
Love it, absolute. Love it.
And this is how I explain why trend following works, and it will work. So as long as, one, there are relatively free markets existing, two, there are humans trading these markets, trend following will work. Now, the problem becomes between hourly bars and monthly bars, right? There is a huge range of time frames in which one time frame will find itself in the cusps of the convergent guys. And it will be and there's no outliers, they're in control. The noise event hasn't happened in their time frame to kick them out. And it's very difficult to trade those time frames with trend following. So that's why people shift from one parameter to another. This works, this now doesn't work. Now, especially in the short term, the short-term space is especially volatile in this sense. Anything between 5-second bars to to 100-hour bars, that space is filled with high-frequency traders who are sniffing out and dynamically back testing over 2, 3, 5-day period windows. They seek what works and they trade that. And as the other things work, they shift to that. So there's a huge mess of things working and not working in this space. And it's very noisy. This happened with the 20 to 40 turtle period before the computers, when everybody was still working in daily bars. People would backtest, 20-day works. Basically, they're asking themselves, what is the shortest time frame I can trade? Because shorter time frames with costs, if you can handle cost, transaction costs, shorter time frames give you better Sharpe ratios. So everybody piles up into the shortest possible time frame. That's why everybody, when you go to like funds and whatever, I say, yeah, we want short term. Why? Because it's a Sharpe 4 and 6. Yeah, it's Sharpe 4 and 6 until it works. Until that microcosm, that micro universe gets invaded by another company that invested $100 million in faster computers closer to the exchange with the fiber optics. And then that Sharpe switches to minus, to making money. That's Sharpe of 6 switches to making money. So in the sense, yes, the shorter time frames you trade, you will have a higher Sharpe ratio, lower drawdowns, but then the volatility, the expected volatility as to how long and unpredictability, how long that's going to work is very significant because you're fighting against a chaotic micro universe of agents. So the more you expand out of the short term, so the more you expand to the longer term, the universe of players becomes more stable. Because becomes more stable. And why? It's also because the longer term you go, the amount of players needed to push the market against you or to bring it to a level where it kicks out of the trade, it becomes huge and it becomes very significant. Now, but that's very good for long-term trend followers. What's not good for long-term trend followers is that, yeah, we're saying, yeah, 200-day always works and whatever, whereas 20 to 40, not so much, and whatever. What if the crowd, the 99.99% who are jumping into a space and ruining the outliers and then creating them again and ruining them with their chaotic behavior as they lose money to trend followers, what if we have yet to experience a period in which even the 200 and 400-day breakouts becomes invaded? As the crowd, as the zombies shift from shorter and middle to longer term. The fact that it hasn't happened, it may be just a fluke, because 30-year backtest on a 400-day breakout, creating, I don't know, 10, 20 trades, may just say that the time hasn't come when the zombies and when the convergent traders and whatever have come in here to basically populate this space. So it could be. There is a chance that it could be just a fluke. As the demon of chaos, as the demon of unpredictability shifts across time frames, could it be that it just hasn't visited the long-term space yet? Because long-term space, the demon, like on a 100-hour bar, the demon of chaos can visit it 3 times, 4 times a month. On a 400-day time frame, it needs to visit it twice in 40 years, and it just hasn't happened that we have experienced it. So what are your comments on this, guys?
Firstly, I'm glad I'm taping this because that was fantastic, absolute. And yeah, maybe we haven't been visited by the demon of chaos yet, but yeah, I get where you're coming from.
Well, I thought that.
But absolute. Sorry. Oh, sorry.
I thought you were. I didn't. I just need. Once I get finished making this comment, give me one sentence of what I lost track of what you were saying and about the demon, but I thought you were going to say that what if these shorter term convergent traders that cause us a little bit of grief because they're creating more volatility in this eventual outlier. The market's going to go where it's going to go, and but we're going to have like the big rally back a couple months ago in the bonds, like huge monster rally, and yet now we were at new lows recently. So I thought you were going to say, what if that goes away and you don't have these big um, counter trend moves any longer? If things get so much better, then trend following becomes easier. So, but I still think that these endogenous trades are going to last a year or two, and so it's not like we need to probably change our response too much to this easier trend following has gotten so much easier. We can look at 50-day breakouts, but I don't think that's what you're saying. What form does this chaos visit on long-term trend following? What does it look like?
Yeah, I don't know. I just so yeah. I also forgot another comment. I will answer your question, Jerry. So another comment. Since I explained maybe 5-10 minutes ago how I explain why outliers happen, and I think outliers happen because convergent traders get kicked out of their strategies and investors cool off and then they start losing money. I honestly think there's no other reason. The only reason why markets have the fat tails is because of this. This is serious, I think. So I believe we should not be frowning upon the existence of convergent traders. They're not destroying trend following, they're creating it. If we were all trend followers, trend following would not exist because
They're
futures
giving us
are.
our food. They're giving us our
Yes,
food.
yes, you have to eat them because somebody has to eat somebody else to make more than 5% a year. Trend followers are eating the convergent traders based on their human biases. That's it. That's the explanation. If you, Jerry, convinced every investor in the world to become trend follower, trend following would stop working. We would not have. Who are you going to take money from? How is it possible everybody to make 30% a year in futures? It's philosophically impossible. So, uh, so, so I wanted to comment on something else. Because the visitation of this demon of chaos is not binary. It's not that like, oh, now the demon of chaos is visiting 100-day time frame and 100-day is going to stop working. First of all, he's not visiting all markets in all time frames at the same time. Second of all, it's not binary. The chaos can come in grades. It can come from 0 to 100%. So when Richard says, I'm focusing on the outliers, he's dividing markets in two modes of existence, of two modes of operation, and it's binary. This market is now in an outlier. I'm riding the trend. I know nothing. There's no information. Or this market is now in the linear part, where the convergent guys are in power and whatever. I would say I would not divide the world so binary, which is why I like to dip into the other part of the distribution. Why? Because even if the demon of chaos visits a certain time frame at 50% or 30%, so even only half of the players half of the convergent players in that universe get kicked out of business, investors get cooled off, and then there's a small outlier. I'd like to be exposed to capture that. And then it comes and then it stops. Because the other half of the convergent traders are still alive. They still know, oh my God, now I have an opportunity to enter this convergent trade, and they're going to push it back. So for Rich's and Jerry's outliers to work, all convergent players in the time frame in which they play have to go bankrupt. Investors get, oh my God, what did you do to me? We had sharp 6, now it's all gone. Everybody has to capitulate to create the huge outliers. Whereas I'm saying, no, I'll take the money even from the 30% convergent guys that could capitulate. 70% can still be in business, and they can manage to make this market back into convergence. So I view the world less binary than Rich and Jerry. So both in distributing risk across timeframes, across markets, and across targeting who am I going to take my more than 5% return from.
I think that's great. Absolute. And I think that's where perhaps Alp and you are prepared to sort of entertain the shorter term regimes, to dip your toes into the bulk of the distribution. that's beyond my skill set. However, I do appreciate where you're coming from. But something you said really struck home to me, and that is what we find as we step out to the longer term timeframes is more and more participants start getting their behaviour starts getting represented in the price movement of that series, and the distribution becomes more stable. That makes total sense to me, because what I think is happening is that as we are moving out to longer term timeframes, the trader impacts, we're getting these correlation offsets in all of these different behaviors being expressed, and we're getting these correlation offsets. It's making the signal cleaner as we step out to the longer term time frame. So that was just something I really liked what you were saying there, and I think that's what you're getting at. Is that what you were saying?
Yes, because the signal to noise ratio improves proportional to the amount of human psychology entering the motive behind the trades. And what I mean by that is when most people who have a system, and a lot of people, most people have systems even if they don't systematically trade, right? So even if they're discretionary, they have a system. They know, oh, I buy stocks with PE of 10 or lower. So that's a system. So when you can bring a certain market in a certain time frame where most of the people who have been doing this convergent system trading, whether it's value or whatever, they get kicked out of their comfort zone. And it's not just the investor, it's not just the fund manager, it's also the investors. He has to hold them together because they're going to walk out. So basically, when you come to this level where more and more of the market moves become driven by pure human psychology or fear or greed, that's where the signal to noise ratio improves, and that's why you're targeting the outliers.
Many thanks.
Okay, that's fantastic. Absolutely, you got to chime in much quicker. Can't wait in the last 30 minutes. We need that your point of view. I wanted to. I do have a question. I want to encourage people to send me direct messages. So I got a direct message question. I do want to answer this before we sign off, and that is the question is on the topic of longer term lookbacks. I assume this applies to moving average crossovers as well, and I would say yes, it does. So I've always liked that 50 by 200 Golden Cross. I did research on Golden Cross. I own the trademark for Golden Cross trading or something like Golden Cross Index, I think. I have some trademark in the US and Canada that I've had for a long time because I thought I might create a fund or an ETF and with the Golden Cross. And it's basically just, I think it would work pretty well with a long-term breakout as well, be about the same. As I've said before on this spaces, I like the breakouts because they buy the highs and sell the lows. And sometimes these moving average crossovers, they don't do that. The market can rally, and then it creates a short system or short entry, and vice versa. It just always struck me as wrong. And are there any benefits to moving average crossovers that are not found in breakout systems? That I don't know. I mean, I doubt it. I think it's the opposite. The breakouts have a tendency to maximize your staying in the trade and hanging on to the outlier and the loose pants concept a little bit better. But sometimes, of course, that's not going to work because it'd be better to get out quicker. But I think overall, it's better. And I do think the answer, though, is more than likely trading both. Trading breakout systems, and you get some benefit to trading breakouts, long-term moving average crossovers. And I know that I got some of that from Moritz. I know has done research in that area more than I have, and he trades, I think, moving averages and breakouts, and then another methodology too that escapes me, but I remember back during COVID times he talked about that on the podcast, I believe. So I think diversification in your trend following, your parameters, breakout parameters, your type of trend following, moving average crossovers, I'm sure are fine. That probably helps somewhat, not as much as the diversification you get from trading a lot more markets, let's say. Although I haven't done that research either, and that reminds me that we used to argue about that on TTU a lot. So anyways, any comments on breakouts versus moving average crossovers, please weigh in right now. Okay, so thanks for that question, Andrew, and anyone else who wants to in the future send me a direct message question, I will try to answer them. And I will take this opportunity to say thank you to everyone. It's been a lot of fun. It's been very fruitful. And we'll do it again next week, same time on Friday, 8 a.m. Eastern. And I wish everyone a good weekend and successful trading always. Thank you for being here. Thank you for all the positive feedback. See you next week.